One of the most popular finance YouTubers, Meet Kevin, is significantly bullish on Tesla for the long term. In fact, he has an actively managed ETF where about 20% of that portfolio is in Tesla. And with Tesla reporting numbers this past week, it was obvious that he was going to make videos about them, and unfortunately, some of these things were not entirely accurate. So in this video, I want to share the things that Meet Kevin missed and share whether or not I believe Tesla is now a buy after the massive sell-off that we have seen from this company. But I don't want to waste your time, so let's go ahead and dive right in. So Tesla reported their delivery numbers on January 2nd, and the next day the stock fell over 12%. It was reported that the company missed on deliveries as they only delivered 405,278 vehicles. Now, what Meet Kevin said is that the company only missed deliveries by about 3%. And the reason why he used this number was because he mentions that the analyst expectation was 420,760 according to Bloomberg. And this expectation wasn't entirely true. In fact, if we look at a different source, we can see that analysts expected over 430,000 vehicles, which would be over a 6% miss. And based on the price action, it was clear that this missed on many people's expectations. The next thing that Meet Kevin said is that Wall Street is blind to the fact that Tesla is growing substantially faster than they think it is. And what he does is use the quarter-over-quarter numbers to justify their growth. From Q3 to Q4, Tesla grew just under 18%, which appears to look like a big increase. But what was their growth last year? Well, in 2021, from Q3 to Q4, revenue grew over 27%. So in other words, their growth over the past year got cut by a third. The other thing is that you cannot use quarter over quarter as a projection for the year. In his video, The Tesla Stock Implosion, Meet Kevin shares how the 18% growth from Q3 to Q4 would be 72% annualized growth rate, which looks fantastic at face value. But what happens during the other quarters? For example, if we look at Q2 to Q3 of 2021, we can see that they only increased deliveries by 20%. So all that is to say, we cannot simply use one quarter over quarter comparison to justify Tesla's growth. But I think the issue when it comes to Tesla is not what they're going to produce for revenue in Q4, because we're just starting to see signs of new car sales declining this year. My biggest issue for Tesla is what they're going to produce for revenues in 2023 when there are high interest rates, lower sales in the macroeconomy, and a high amount of used Teslas. And even if you are a long-term investor, the numbers that Tesla produces in 2023 will impact the following revenue numbers because they have to grow even faster to make up for the lower growth. Now, with all that said, Elon Musk is confident that they will be able to increase deliveries on average 50% annually for the foreseeable future. This all comes down to whether or not you trust Elon's judgment or not. So the next piece of the video that Meet Kevin talks about is the average price of a new vehicle, explaining that Tesla's Model 3 is actually around average price. And this is the case, but can we actually use these metrics? Here's where I believe things go wrong. You cannot compare the Model 3 in this case because what if trucks are included in this statistic? If you include trucks, not only is the average selling price going to be higher, but then if you remove these vehicles, the Model 3 could then become one of the more expensive vehicles. Granted, the Model 3 is much cheaper than the average electric vehicle sold, so as more and more people go electric, they may end up with one of the cheapest models. But that will take time for people to move to electric, especially because of the recession. Now, I want to cover something else that I find to be interesting, and that is Meet Kevin using analyst estimates to justify Tesla as a buy. Analysts expect this company to do 36% revenue growth in 2023, which is significantly lower than the 55% they are expected to do this year. So I showed this graph in my previous Tesla video, but I think it's important to present this again. This is the light vehicle retail sales over the past 45 years. And what we saw during the great financial crisis from 2007 to 2009 is car sales fell over 37%. Of course, I'm not saying that car sales are going to fall that much this time around, but if you believe sales are going to fall, plus interest rates are probably going to remain high for a good amount of 2023, what kind of growth is Tesla really going to see? We are also seeing massive job cuts and are likely to see more over the next year. Who are the people losing jobs? It's not the lower wage jobs because we're still seeing those stores hiring. It's those that are making over 100K, and this group is who Tesla is selling to. So if the people losing jobs are the same people who are more than likely going to buy Teslas, what kind of growth are we really going to expect over the next couple of years? I don't think this is something many people are considering. Now, of course, when market conditions come back to normal, then we should be able to see an acceleration in growth. But when you run the numbers, the growth that analysts are expecting, in my opinion, represent a fantastic year for Tesla. And if they have to reduce revenue projections, you know what else they would have to push down? Price targets, which will have even more downward pressure on the stock price. Now, there is one last thing that I want to touch on, and that is their EPS, which is also projected to be much higher than this year's number. In order to meet estimates, you would have to to assume that Tesla will be able to maintain their margins and not reduce prices for their vehicles again. And when you go into a scenario where you won't have much growth, plus interest rates could continue to be high for the next year, what is Tesla going to do to sell their vehicles? If Tesla prices come down and costs stay high, that will affect margins and then EPS. And we are already seeing price cuts. In October, they reduced their prices in China by 9%. And then it was reported that there were more price cuts for the second time in 3 months. And they have competitors that are charging much lower prices for other electric vehicles. Now, margins can be impacted by many factors. And the thought is that because commodity prices have fallen drastically, Tesla will be able to maintain their margins. But when we look at China, how much do you think prices have dropped since September level? Depending on the vehicle, prices fell between 13 and 24%. And because we still have high commodity prices in comparison to a few years ago, this puts strong downward pressure on margins. And what do margins affect? EPS. But China is not the only place that is experiencing price cuts. In fact, there are price cuts in Japan, South Korea, and Australia. Now, the argument here is that because the Shanghai factory is their most profitable factory, they can take hits on margin so that they can keep demand up. But how is this going to affect Tesla's EPS over the next couple of years? And this is the balance that Tesla is facing. How much margin do they want to give up so that they can take market share? I do think that they are doing the right thing, reducing prices, but this will have a longer term impact. This could mean that in the short term, like the next year or so, the earnings growth may not look great, but in 5 years from now, the company could be in a totally different position to where they can increase prices again. However, the one thing that will hurt Tesla is Tesla themselves. People buy their cars because of the product and the brand, and I firmly believe that it is their brand that helps them sell expensive vehicles. This is also why Apple did so well. It wasn't because Apple has the best products, because there are plenty of other companies that produce great products for significantly less. So what allows Apple to sell their products at a premium? A good product with a good ecosystem and a great brand. And unfortunately, Tesla's brand has faced some challenges. In my previous video, I shared how Elon's outspoken political stances could have an effect on the people he is selling to. But on top of this, we are now seeing protests in China as owners demanded rebates and credit after the sudden price cuts. And they are now saying they have felt like they have overpaid for their electric vehicle. Now, of course, there is definitely going to be the possibility that it only lasts for a couple of days, and then in the month of February, everyone forgets that this ever happened. But this, I believe, is still something to keep an eye on because of the simple fact that all eyes are on Elon and Tesla. So the slightest mistakes will not only be noticed, but be magnified as well. And this is not including the lawsuit against Elon, who is trying to move the trial to Texas because there are negative biases against Elon in California. And we know if he loses that lawsuit, which is a possibility, I don't want to say it will happen, but there's a possibility that he could need to sell more Tesla shares, which he said not too long ago that he is done selling Tesla shares. And unfortunately, this isn't the first time Elon Musk said that he's not going to sell shares and then he ends up selling. And even something like a lawsuit could affect the Tesla brand and demand. Now, why do I bring all these things up? I have to mention that I was a shareholder in Tesla, so I like seeing the company perform well. At the same time though, I think it's important to share different perspectives, especially caution flags to look for with companies. Do I think Tesla could be the largest EV maker in the world? Yes, but I do think that Tesla has some obstacles over the next couple of years that will give shareholders a better idea of what demand is going to look like and what is actually a healthy margin for Tesla. So when it comes to myself and buying this company, I have to wait to see Elon stick to his word and see Tesla deliveries hold up for the next quarter or two. I think by around the end of Q2, analysts will bring down their estimates and we will get a better idea of what new vehicle sales will look like, not just for Tesla, but for the entire EV sector. Hope you all enjoyed this video and I'll see you in the next one.